Now, I am what they call a price action trader, okay, because I don't really trade from indicators. I don't use oscillators. I actually use very little fundamental analysis also, but I do pay attention to my economics calendar. But to really understand price action means you just study what has happened in the past, then observe what is happening in the present, and then predict where the market will go next. Price action is among the most popular trading concepts. A trader who knows how to use price action the right way can often improve his performance and his way of looking at charts significantly. Now, price action all takes place on your chart because it's all about reading the price that's on your charts. Now, it's a favorite among most short-term and medium-term traders. Price action trading brings together an interesting mix of information and different views. These include historic price patterns, technical indicators, and investors' ability to read the markets. Now, like I said, I'm a price action trader. I trade from chart patterns, my favorite being triangles if you ever attend my classes, support and resistance levels, and moving averages. Those are my backbone. And of course, trends and volume. Now, as many of the decisions associated with price action trading are subjective, what one investor may see as a breakout, another may see as a potential price reversal. Compare and contrast this with pure technical analysis, where you effectively ignore the experience of investors in favor of cold, hard trends. Human nature dictates that futures and commodities prices, currency prices, cryptocurrency prices can be extremely volatile. Overbought situations are often created because of fear and greed, while panic selling can take over in the event of disappointing news. There are types of scenarios where price action investment strategies can prove extremely lucrative. The key to reading price action charts is to take in short-term fluctuations. It's also critical to notice emerging trends and focus on patterns which repeat time and time again. Historic patterns like triangles, or even your support and resistance levels, and then using them with certain very specific candlestick patterns, trend lines, and moving averages can give you an entire trading system. For example, when a chart is about to crash to a support level, it's unlikely to do it in the one fell swoop. Okay, you can have price go. I mean, nothing stops price from moving. Price is the only truth in the marketplace, and price decides what it wants to do when it wants to do it. But recognizing these levels where price, or steps where levels where price has hemmed and hawed in the past, or the steps of a price movement, to know what that step is, makes you a more knowledgeable trader. Short-term traders sell into the bounce while buying interest begins to wane and sellers again take control. Eventually, the price will crash through the support level, often prompting an array of short selling. So let's go over and take a look at some live charts so we understand what we're talking about here. Okay, historic prices. Now, this is my Euro US dollar teaching chart. You see all across it, all of these lines. They're, I describe them like roadmaps. When you look at an old-fashioned, maybe some of you don't know what a roadmap is anymore because we all have GPS these days, and none of us really look at maps much anymore. But I remember, years and years and years ago, when I was doing a seminar, especially we did a lot in the UK, my business partner in those days, Peter, could read a map. He pulled the map out of the glove box and could open it up and get us to exactly where we're going without a hem or a haw, without getting lost. He'd know right where the petrol station is. He'd know right where the roundabout was. He would find the building in 2 seconds by reading these maps. I couldn't do that. I didn't have the eyes for it. I didn't have the familiarity. But now when I look back and I look at charts and I see all these colored lines and all these legends and all these keys, I realized it was just because I didn't spend enough time reading the map to get familiar, get my eyes familiar with it all. Now it happens to be these lines going across my chart here. These are my support and resistance levels. These are historic levels where, in this case, where the euro, when it traded the last time it was in this range, what prices were significant. Now, all of my color coding has very little to do with you guys. This is my own color key system. I use dashes to tell me whether I have a major support line, a minor support line. I use colors to let me know how long ago, where they put on my charts a year ago, because when you put your support and resistance lines on chart, they could have been put on 2 years ago, 3 years ago. Okay. And then I darken the colors to see how important they've been in recent trends. Okay. I understand which are majors, which are minors, but this is my own key. What you have to do is develop your own key, your own way to interpret your lines that you're putting on a chart. So when you look at price action, it looks familiar to you. You can interpret it. Then I used to only trade from bar charts, never use candlesticks. Not because I have a problem with candlesticks. When I started trading 40 years ago, we were hand charting. Most people use bar charts because they were faster and easier to draw on our graph paper because you're sitting there writing all of your charts. Few people used candlesticks. Now today I love candlesticks because with all the modern charts, the HTML and the Java charts, candlesticks are easy to deal with, easy to see, easy to customize, and are flexible. So by simply watching my price movement and my support and resistance levels, I can really start to understand what the markets are telling me. I can start reading what's on the price of the chart. And this is the basis of price action, because you get familiar, you get to feel it, you get to be able to read that roadmap quickly and understand what it's trying to tell you. Now, this is a daily chart of Bitcoin. It's quite, back, it's a live chart, but I put these lines on a while ago. And you can see these areas of initial support around price. You can see where I have the wedge on here. This is part of chart patterns. But once we're looking at price, we can start interpreting what it's telling us. Now, it's really nice for me in class to draw you these beautiful little graphics. But remember, things look like this. Yeah, I'm going to tell you this is a well-developed trend. Push and ease, push and ease, push and ease, push and ease. But the fact is, the markets really most of the time look like this. So keep in mind, it's not as clear cut. Now that's why I teach and try to use live charts, because then you're actually seeing what it looks like in the real markets. But by learning to read what the price is telling you, and by setting a few tools on here to interpret that price, you have an entire trading system or filter system to let you know when you have good trades, bad trades, a possible trade, a good signal or a bad signal. And then we have patterns that appear on our charts. Okay. We have things like head and shoulders. Now there's certain well-recognized patterns that we all use. There's others that people talk about, but they're really of no validity for us. Okay, a bullish head and shoulders or a bearish head and shoulders, which is just the reverse, is very hard to ever see in the marketplace. Okay, it happens all the time, but it's hard to recognize and wait for it. And then we have things like double bottoms. Okay, double bottoms appear on your charts all the time. And just because it's got two touches of a support line or resistance line or two touches of a new price level, it's two bounces in our type of market where the market's moving very quickly, has no validity. So a double bottom is just a pattern that appears on a chart where price goes down, hits a specific price, bounces up of it, comes down and hits that specific price again and bounces off of it. But then we come to triple bottoms and triple tops. Okay. Once we start seeing price bounce off more than 3 times from that same price level, we start to have some more reliability. Okay. But there's things like rounding bottoms. People swear by them, but I don't see them on my charts when I'm looking for them. Rectangles, bullish reversals, these are all patterns. Now, as I mentioned, I'm a triangle trader. I'm a chart pattern trader, but I lump things like bullish wedge. To me, this is all just a triangle. So when I'm reading price, I don't care. The difference between a triangle and a wedge is the two lines are different degrees as they're reaching into the apex. But to me, in my definition, there's still a triangle. And then we have ascending triangles where we have a horizontal resistance and a support line in an angular. We usually get this in an uptrend. Okay. And we get the reverse, which is a descending triangle in a downtrend. But they're still all triangles. But the key to any successful price action trading strategy is the removal of peripheral noise, such as fundamental data, and look at the price patterns, trends, and other forms of technical analysis. Now, what I try to explain is the markets are random. Price is random at all times because it's made up of millions of people making decisions around the globe. Now, we have uptrends, we have downtrends. We have sideways trends or congestion, but most of the time we have mess, complete randomness. But there are certain times that we can spot opportunities because the market starts moving in a non-random fashion. And this is what we call an uptrend or a downtrend. When we can see the development of this nice uptrend or downtrend in our charts, push, ease, push, ease, push, ease, we can then, in this short period of time when we're seeing non-random action, apply some good old strategies to find a potential trade. So when combined with good old-fashioned experience and a feel for the markets, this can create a very successful investment strategy. Don't forget, even if you have opened a position based on any of the following price action strategies, you also can apply technical data to set your stop losses. And don't ever enter a trade without a stop loss. Remember, ultimately, it's all about risk management, limiting your risks so that when you have the rewards, you can cover your losses and additional profit. So one of the key aspects of price action trading when using support and resistance levels is the fact that once a support level is breached, it can then turn into a resistance level and vice versa. So as we can see, this offers a very nice potential set of trades, because we could call this triple tops or double bottoms or triple bottoms, but price moved up, bounced off a resistance level, came back down to our support level, moved back to our resistance level, fell back down to our support level, and then moved back upward. Okay. Now, we could have been trading in between these, but the ultimate trade is we'll see when it bounced off and then eventually broke that resistance level and was starting to move into an uptrend. We could have then gotten in at a very reasonable price, set our stop loss right below the breakout, and followed that trend as it followed up and up and up by simply reading the charts. Then there's also combinations, whether you're using bar charts or candles, like I love indecision candles and bullish engulfing candles. To me, they are key important players in my reading price action. The rest of it, I don't pay any attention to. But we have also pin bars, or we call them inside bars, outside bars, or mother bars and baby bars. And when we get these developing right on a support or resistance level, they can be very important to us. Many price action traders are extremely vigilant. They're always on the lookout for what are known as inside bar patterns. You can recognize these by the emergence of a second bar within the body of the previous bar. Or we call this the mother bar inside bar. The mother bar is the largest of the two bars, and the baby bar, or the inside bar, is fully contained inside the previous body of the previous candle, or the previous bar, in the opposite color. The primary bar is sometimes described as a mother bar, will often indicate a period of consolidation and potential turning points from key support and resistance levels. So when we get a baby bar and a mother bar formation directly on a level of support or resistance, or we get a bullish or bearish engulfing right on a level of support and resistance, price is trying to tell us something. It's only when you take the time to understand how bar patterns emerge and what they indicate that you can position your trades. Don't forget to also keep one eye on your stop loss limits at all times. So as you gather from all the above information, price action trading is based around trends and momentum. The idea is simple. Once a trend changes, then the momentum often grows, and it is only when a stronger opposing trend emerges that the direction changes again. In between these relatively strong trends, there are periods of consolidation, sideways trading, and price will often bounce off support and resistance levels. In many ways, support and resistance levels are self-fulfilling prophecies. Many traders now use technical analysis and take them into consideration. However, price action trading offers the best of both worlds with both technical analysis and human input from a trader. So remember, don't take action with a trade until the market itself confirms your opinion. Looking at a chart and making decisions without some supporting information, without confirmation within the chart, can be a very foolish move. I always use volume to confirm my final opinion anyway, because you don't want to be an impatient trader. Now, there are numerous disadvantages and advantages using price action trading strategies, and ultimately it comes down to how disciplined you are as a trader. Many of the strategies we mentioned above be overcautious by some people. When waiting for a definitive change in trend, there may be times when intraday prices could spike above resistance or below support and then recover. These can be false flags and can be potentially expensive in the long run. Now, when looking at your chart trends, not all traders will have the same opinion. Some will go long while others will go short. These decisions are based on their opinion of the technical analysis as opposed to the fundamental analysis. Now, please don't mix up technical analysis with technical indicators. Everything and anything we do on a chart is technical analysis. So all of price action is technical analysis, although we could just call it chart analysis. So whether you are actually ignoring the fundamentals is debatable, because in theory, contract prices today should reflect all the information in the public debate. But it's a foolish thing to ignore fundamental analysis, because one fundamental event in the middle of your trade can mess you up for just a couple seconds, because it can cause added volatility to the markets at that moment. So without knowing what is happening in the marketplace, what headline just popped out, or what economic event is just coming through, coming out, is foolish, because you can't plan where to put your stop loss without understanding the potential short-term volatility you might be facing. So while price action trading is based on technical analysis and the reading of the situation, it's not always cut and dry. So one classic indicator that a trend is changing is high trading volume. So if the price is stuck in a bound range, bounce between resistance and support under relatively low volumes, one investor may see this as a trading opportunity. Now, I don't trade those bounces between support and resistance because I only believe in trading with the trend. And when you're trading the bounces in between support and resistance, you're not trading while there's a trend. Now, I will wait for the breakout of that to see the development of a future trend. But what is your little confirmation figure? When you see that breakout and the possibility of a new trend developing, you should see an increase in volume. So the question is, does price action trading demand discipline? Well, price action strategies can highlight periods of consolidation, the emergence of new trends, and phases of sideways trading. But it does require discipline because it's too easy to get your opinion in your head, try to turn it into fact itself, and then force yourself to make a trade. The key is to see what is in front of you as opposed to trying to manipulate the chart data into what you want to see. The basic difference is that price action incorporates both technical analysis and human input. Effectively, you are monitoring emerging trends and reading these with varying degrees of discipline and experience. And you can slip down a very nasty hole if you're not disciplined. But if you are disciplined, okay, and just like my business partner reading those roadmaps, if he just stayed to those roadmaps and read everything that was on there, we would get right where we're going when we had to. It's when he started to make assumptions, or when there was an accident on the highway and he was trying to jump us off at this exit to jump us back on that exit, that it got a little muddied and confusing. So while there's a degree of human input with regards to price action trading, there's also need to be discipline, even if you are marginally miss out on several trades. The idea is blunt. When the turning point occurs and the momentum builds for a new trend, you will be there. So thank you very much for being here. I hope you learned a little bit about price action, and you also learned that you don't have to overcomplicate your strategies and overcomplicate and overthink your trading. Understanding where to put your stop loss, evaluating your risk management, and getting an entry point and a direction is all that it's about. But you're not in the game until you actually make a trade. But the ultimate and most important thing you can do at any given time is manage your risk. So thank you very much for joining us tonight. If you have any questions, contact Alvexo, and they'll be glad to answer them for you. Or you can go on to Alvexo and learn about strategies, read about all kinds of things, or talk to a financial analyst who will help teach you how to do this on your own. Thank you very much for joining us, and have a great trading week.